Right. Just give it half a minute or so. Just let's see if we've got any late joiners. Okay, so time is a bit tight. This is our first event for the cyber group in 2022. I just wanted to introduce Zanar and Carlos, the committee members from the cyber group. And I just wanted to say particularly thank you to Zanar, who's really the organizer for today's event. And I'd also like to say thank you to Rory, who's presenting the presentation. So I'll pass over to Zanar now, and yeah, enjoy. Thank you.
Thank you, Alex. Hello, everyone, and welcome to our webinar. We are very lucky today to have excellent speaker. Let me introduce, we have Rory again today, who is the International Head of Cyber Analytics at Aon Insurance Brokers in London. Rory has over 16 years of experience in the insurance sector, actuarial and cyber risk. Before joining Aon, Rory worked as a senior underwriter, senior cyber actuary, and cyber consultant for Munich Re Cyber Center of Excellence. Prior to this, Rory worked at AIG in London as a corporate actuary and insurance risk manager, and also spent 5 years with RACQ Insurance in Australia. So on this note, we would like to give the floor to Rory to start. Rory, hand over to you. Thank you.
Thank you, Zanar, for the introduction, and thanks to the IRM for hosting this webinar today. And the topic is around systemic cyber risk, and more specifically how the insurance market looks at that as a topic. So I'll be covering as sort of broader context where the cyber insurance market is as of today. A key part of systemic risk, which is around what is considered to be insurable and therefore what should be covered, and broader context around the current and potential future threat environment we're facing and how that links with the potential for aggregation or systemic risk or cyber catastrophe risk, whatever you prefer to call it. So the first section is on the market, and I've taken a lot of statistics and trends from a report that's publicly available, provided by Aon. It's the 2022 E&O and Cyber Market Review, so I encourage you to go and have a look at that in your own time as well. So in terms of what businesses are facing from the cyber peril at the moment, it's more frequent cyber attacks. These are getting more targeted, more sophisticated, and ultimately more costly. And currently, since about 2019, the main driver of that is ransomware. So ransomware is a much more effective way that the cyber criminals who are financially motivated have found compared to before that. To extract money directly from their victims, whereas prior to sort of 2018, 2019, where it was more data breach focused, where it was a bit more indirect in terms of them making money, they had to exfiltrate data and then find someone to sell it to on the dark web, for example. So it's a much more direct and effective criminal business model that we're seeing now, and that's what we're, as defenders, having to deal with. And just to illustrate that trend further, this chart shows the sort of run rate of frequency from ransomware attacks on the upper part of the graph compared to data breach attacks, which were the dominant claim type pre this ransomware trend. And we can see that ransomware's frequencies increased dramatically, up 323% since the beginning of 2019, whereas data breach conversely is down by about 75%. Since then, and we're starting to now also see a combination of the two, where a ransomware attack occurs alongside a data exfiltration, and that's where hackers are trying to increase their bounty, if you like, from the criminal, from the victims by extracting that data and forcing or trying to force the victim to pay a higher ransom. So all of this activity I'm talking about is what I would characterize as attritional claims. So they're not necessarily systemic. But there has been systemic activity as well, and a couple of events over the last couple of years which could be characterized as near misses or sort of warning signs that there is systemic potential from cyber. So events like Kaseya and Microsoft Exchange, and late last year we saw the Log4j vulnerability. So none of those events had a meaningful loss impact on the cyber insurance market, but they certainly gave us a lot to think about and were good reminders, I think, of the systemic potential here. I'll come on to pricing in a minute as well, but I think it proves the point that in order to have a sustainable level of pricing on cyber, it's not just about responding to that attritional trend, but building in loadings for the systemic loss that could be covered as well. And of course, we have the ongoing war in the Ukraine, unfortunately, and from a cyber perspective, that has shifted some of the activity, but we haven't seen in terms of insured losses any meaningful uptick as a result of that. But I've got another slide on Ukraine, which I'll cover off in more detail later. So from the insurer's point of view, how they're responding to that ransomware trend in particular is by pulling back a little bit or being more cautious. So they're less willing to put out larger capacity per client. So we're seeing, for example, where they might have put out $15 million in a limit, that they might pull that back to, say, $10 million. There's huge rate increases going through as well, and I've got a slide which will show that. A bit more caution around which coverages are offered. So we're no longer in this kind of soft market phase where the coverage is ever expanding year on year. It's kind of the inverse of that now, and a bit more caution around what the bounds of the policy should be. And the underwriting processes are much more stringent now. So the insurers are much more willing to walk away from risks that they may have underwritten in the past. They're demanding more in terms of minimum security controls. They're asking more pertinent questions with a specific focus on ransomware, and just really lifting their game in terms of making sure that the weakest links in their portfolio are much stronger than before. And from the capital point of view, so the capital providers, which can be the insurers, can be their reinsurers, and I think reinsurers are a very important part of the market. They support roughly about 40% of the original gross written premium for cyber. So they have a very big say in terms of how this market can function from a sustainability perspective. They've got typically deep pockets in terms of the capital they can deploy, but not unlimited pockets. So they want to know that the business is being written responsibly. They'll put a premium on supporting cedents who can demonstrate that they're handling systemic risk, for example, well. And ultimately, when that capital does dry up, and because of the growth in the market that would happen at some point, and Aon is helping with this as well, new capacity needs to come to the market. So a lot of this is around packaging and describing cyber in a certain way that makes it attractive to capacity providers, capital providers from outside the insurance industry as well, and building trust in the way that we underwrite and the way that we describe risk and quantify that with modeling. So unsurprisingly, the pricing trend in terms of how much it costs to buy a cyber insurance policy pretty well mirrors that frequency trend that we saw. So especially the second half of 2021, we saw huge rate increases where the price more or less has doubled on a risk-adjusted basis. And actually in the first half of 22, we've seen, or anecdotally, we're hearing that that sort of trend has continued. So perhaps it won't be until the second half of this year where things might start to stabilize a little bit. And in terms of the structures of the policies that are being sold to clients, typically clients are being asked to share more in the risk. So about 65% of clients, according to this Aon data, did see increases in their deductibles or retentions in the second half of the year. So more risk sharing. And that's also an important point when it comes to modeling the systemic risk. So having higher retentions and deductibles does give a meaningful benefit when it comes to modeling the losses from realistic disaster scenarios. So moving into 2022, what to expect? I already touched on the rate, so a bit more to come perhaps, but maybe not at the heightened level we've seen in late 21 and early 22. Underwriting focus will continue to be very rigorous, and I think there'll be more reactivity to real-time issues in cyber. So when a new vulnerability gets discovered or when there's a shift in the geopolitical environment, the insurers and also their reinsurers will want to know how vulnerable a given insured is to that new threat that's emerged and get an answer in real time around how that's being responded to. I think some client segmentation or differentiation will occur for cyber insurance portfolio managers. So identifying the poorer performing segments and being a bit more underweight in those compared to the better performing segments. But I think there's a general recognition that you can't really over optimize for that in cyber because the threat landscape constantly changes. So what was a poor performing segment 2 or 3 years ago may be a good performing segment when those companies lift their game or when the threat actors move on to a different segment. So it will happen to a degree, but there's no kind of silver bullet for sort of optimizing a portfolio according to certain segments of the customers. But more and more, I think the conversations that the markets will have will be around systemic risk. And I think outside of the people actually underwriting the risk, other people in the organization, the risk department, the board, and their external stakeholders, as they see these trends in terms of Ukraine and ransomware, but also the huge growth on cyber, they'll want to know how the insurance companies are getting a handle on the aggregation risk and pushing for greater transparency around exclusions and the approach to quantifying that risk. So I am an actuary, so by nature I want to jump into the modeling, but I do have a sort of point to make around before we jump into modeling, we have to make the decision around what we actually consider to be coverable, insurable on a sustainable basis. And therefore, I would talk about intolerable risks or unmanageable risks. And I think we can look at that from 2 different lenses. So on the portfolio level, that's around identifying particular threat scenarios which the insurance industry would struggle or fail as a market to provide cover for because of probably the scale of those events and also, I guess, the modelability of those events in terms of truly being able to understand at a technical level what is possible, what the likelihood of occurrence would be, and then what the severity would be. But I think there's a couple of buckets we can talk about there, and the first one is critical infrastructure. So we know that nation states have been poking around in power grids across the world, and there has been an attack by Russia against the Ukraine in 2015, where they're able to disable power for a large portion of the Ukrainian population. So it's technically feasible. There are motivated threat actors. And if we can sort of reimagine an event like that on a broader scale with a more long-lasting outage, and in the case where the insurance industry was providing business interruption for such an event, then it would have a big problem. So that one, I think the market has pretty much by this point reached consensus on that that's probably not something that should be covered in a cyber policy. And when we talk about critical infrastructure, it's the power grid on one hand, and probably the other key infrastructure type that is thought about is the internet and all the different parts of the technology that work together for a functioning internet. And that's another thing that our economies rely on, obviously, hugely. So internet is also out of scope if you think about widespread internet outages, and you can extend that to other critical services like GPS, which have a sort of technology element, which could be we could have a big issue basically if something like that is attacked. So critical infrastructure is out. The next one is war. And so war exclusions have been in place in cyber policies for a long time, but to summarize, they haven't always been fit for purpose for the kind of cyber environment. So a lot of them were written a long time ago for property policies and things like that. So they're quite clear in terms of how they would respond in the context of a physical war, but not always clear about things like nation-state cyber attacks, which can occur during a war, can occur outside of a war in a sort of peacetime environment. That I think is something that the market is working on better analyzing, understanding, and finding a kind of fit-for-purpose war exclusion for the cyber age, if you like. And within that, there's probably a couple of buckets to talk about. There's, I guess, what we're seeing currently in Ukraine with cyber attacks carried out in the context of a physical war. And I think that probably the exclusions are not too bad in terms of handling that. But one thing, when people in the sort of risk modeling, risk management community, when we discussed around nation-state threat actors and cyber attacks, we could imagine this kind of war-like cyber conflict where it's the arena of conflict is in the cyber area without necessarily having tanks on the ground and drones in the air and what have you. So there could be a kind of escalation of what we know is already happening, where there's nation-state attacks against strategic targets during peacetime. But what about a situation where that really escalates and those attacks are not as covertly done with plausible deniability and trying to limit the damage and limit the probability of retaliation? What if those attacks became much more overt? There was less regard for what comes back in terms of blowback, in terms of retaliatory attacks. So this kind of cyber-only war is an area of focus when the market is now redesigning war exclusions for the cyber age. And I've written down black swans in recognition that we generally take a scenario-based approach for identifying systemic risks, and we have to, I think, acknowledge that we're not going to think of everything, and the scenario that could hurt us is one that's probably not on our list. And I know various groups at companies I've been at before and others in the market, we've written down more than 100 different scenarios that we think could be important and systemic for the market. But I'm sure that we try to limit that space of sort of unknown unknowns, but there could be something out there that we miss. And therefore, when we're defining cyber policy wordings, we have to be able to protect ourselves with those wordings against events that we haven't necessarily thought of. So I guess that's a bit of a warning around trying to be very specific about the events you're excluding. You probably want more of a broad approach that's capturing things that you haven't necessarily thought of. And on the individual risk level, with this ransomware trend, I think it's been good that the market has responded and underwriting with more scrutiny than ever before. And I think this is also really important for systemic risk, because if we think about cyber as a peril, it is different to something like natural catastrophes when it comes to diversification. So it's difficult to diversify your cyber portfolio by geography. I think some of these near-miss events that we've seen, they have been have been worse for certain segments of the markets, depending on the affected technology. So it might be a more SME company relevant technology, or it might be a technology that's affected in a given country, or industry specific technology. So diversification helps in generally for the sort of lower level catastrophe events. But if we're talking about our doomsday scenarios, RDSs, where it's a global scenario, everybody's using common technology, which is affected in that case, then it's much harder to diversify for that kind of a scenario. And probably one of the main defenses we have in terms of reducing the likelihood of one of our insureds suffering a loss, and if they suffer a loss, mitigating the size of the loss, is the individual security characteristics of that company. So that's really one of the main levers we can focus on to lower our systemic risk, is the individual security attributes. And in the risk models that we're developing, we're trying to find ways to identify what's kind of security are we talking about, which matters for a given scenario, and with evidence, hopefully starting to give more credit where that security we think can actually have an impact on the loss. So talking about coverage considerations, and I mentioned this has been tightening up in the last couple of years. The first square or rectangle here is just talking about what's typically covered in cyber policy. So it's malicious attacks, it's non-malicious events, generally covering non-physical damage impacts. And probably the most important coverage there is business interruption when we talk about systemic risk. So business interruption needs to be the focus for how the product should look going forward to be sustainable with respect to systemic risk. Silent cyber is another topic that the market, I think, has focused on a lot the last couple of years, and we're in a much better place now than we were, say, 2 or 3 years ago, where a lot of companies, maybe not every company, but a lot of companies have had a holistic exercise to identify potential silent cyber exposures on other lines of business, and they've done a reasonably good job of either excluding that coverage or affirming it, charging premium for it, and tracking it. So that's going well, and I think the focus now is switching more back to the affirmative cyber market and how do we make that market sustainable for all participants. So business interruption, I mentioned, is an area of coverage that is getting focus. But beyond doing just things which are happening, like increasing the waiting periods before a loss can be paid, we are seeing some interesting innovations, and I'd like to see even more of this around incentivizing better behavior on the insured. capturing better data from the insured, and more thoughtful coverage grants around those systemically exposed coverages. So, for example, one of the catastrophic scenarios that most of the industry has agreed upon as being important is the risk of a major cloud service provider having an outage and the downstream impact of business interruption or contingent business interruption for a portfolio of insureds. From a modeling perspective, we can do a much better job of understanding that if we have visibility into which third-party vendors our insureds are most dependent on in order to run their business. So asking the insureds to actually list out those providers and incentivizing the coverage in a way that they'll get more coverage for doing that compared to if they're not giving a list of providers, or if there's an event that occurs and it's happening to a company that's not in their list of named providers, then a lower coverage limit would apply. And finally, on this slide, on the war exclusions, yeah, that's something where they're a little bit fragmented at the moment, but really important that the market doesn't really compete on that, but agrees broadly in terms of what should be in scope or out of scope. And this next section is, again, talking about tolerable and intolerable, and just differentiating between where we should be excluding risks compared to where we can actually take on some cyber cat risk. So taking that sort of broader market view, or the view, let's say, of a global reinsurer, bucketing that systemic risk into the part which I've touched on through those exclusions, which we think is not really sustainable for the market to coverage. So the cyber war piece, the infrastructure failure piece, and the black swans, putting that to one side, but making sure we as a market agree on exactly what that is. And that could be a kind of threshold approach where, we're all roughly on the same page and not sort of competing into that and saying, pick my policy because I have a looser exclusion. It's more just all as a whole market agreeing what doesn't make sense and finding other areas to compete on. And I think that obviously leaves a big hole in terms of economic support for our economies if we're not covering that with insurance. And I think we as an insurance market have a part to play there to have discussions with governments, with the public sector, to basically make them more aware that we're not actually covering every single loss scenario, and that that's something that ultimately, therefore, taxpayers or companies themselves that are affected in such scenarios would have to foot the bill themselves. So having that conversation, the potential for partnership solutions where the insurance industry doesn't carry all the risk but can maybe support with claims mechanisms, for example, I think that's a debate which would be helpful, but it hasn't really got off the ground so far. And then I think once we've sort of defined what we don't want to cover, then we're left with this sort of manageable, insurable cyber cat risk that we can collect exposure data on, we can build models on, we can quantify frequency and severity of events, and we can then therefore price that risk, track our aggregates, and trade that from insurer to reinsurer, from reinsurer to capital markets. So I mentioned that more than 100 different scenarios have been looked at by various groups around the systemic potential. And I think at this point in the game, we've got more or less consensus on what probably the top 2 scenarios are in terms of insurable catastrophe scenarios. So it's widespread malware, and specifically malware where the payload that the malware delivers is destructive. So it's deleting data or encrypting data that you would see in a ransomware attack, but doing that at scale. So sort of widespread, meaning that could be seeded within a otherwise legitimately looking software update. So a software supply chain attack would be an effective way to distribute malware, and additionally malware that has a self-replicating property, then it can effectively worm its way through different organizations. So that kind of maximizing the infection rate through the software supply chain attack and wormable capability, and then delivering a destructive payload. And probably the other sort of main bucket of scenarios is the cloud computing. So thinking of the largest cloud service providers in the world, and them having a major issue which causes widespread outages for hours or even several days, and the downstream impact of the business interruption. So there are 2 scenarios. There's many other scenarios that others have thought of, but I think those are the ones that at minimum should be understood and modeled. And I think that's an area where we can have a dialogue around trading of that risk, measuring that risk, and that requires a lot of transparency in terms of the ones that are building the models that are used for that, because we're doing, I think, a reasonably good job as an industry in building that modeling ability up and collecting relevant data on historical events, for example, and security metrics. But ultimately, what we're trying to model here is of a severity beyond what we've actually seen so far. So we have to be, I think, just aware of that, mindful of that, and have open discussions around the assumptions, the expert judgments that are put into those models, and how we've come to a view as to whether those are reasonable assumptions or not. And I mentioned attacking this also from the underwriting focus. So it shouldn't just be a back-end problem for the risk teams and the model builders. It should be addressed on the front end as well during the underwriting process, and more conscious coverage grants for any coverages that carry some kind of systemic risk alongside. Okay, and this slide here talks a little bit about the current war in Ukraine. Yeah, we haven't seen a big impact on cyber insurance as a result of this. If anything, the ransomware trend is still strong, but there's some reports that it's a little bit down in the last couple of quarters from the sort of highs of 2020 and 2021. Early days to say, and I wouldn't directly attribute that to the war in Ukraine, but we are seeing evidence that certain threat actors are diverting attention towards sort of loyalists to Russia, or organizations proactively helping Ukraine, including hacktivists. So there's definitely a lot of attention on that conflict, or at least in the first couple of months there was. And I think it also shows during an actual war, the sort of usefulness of cyber as a weapon is limited. You know, there's a lot of just it's the impact of any of these cyber attacks is dwarfed by the level of destruction we're seeing on a physical basis. And this is actually my last slide before we can open it up to Q&A, just to give you an idea of how the industry is moving forward with regards to cyber war exclusions. So the LMA is a body that supports Lloyd's in London. Lloyd's markets require war exclusions to be in place across all lines of business, and these set of 4 new war or cyber war clauses were developed and released late last year. Very briefly, on the left, you've got a version which is very restrictive. So this particular exclusion would exclude all war and all nation-state cyber operations, regardless of size. So even the smallest nation-state attack would be excluded, assuming it can be attributed to a nation-state or someone working on behalf of the nation-state. Whereas on the right, you've got the other end of the spectrum, where this is recognizing that not all nation-state attacks are the same, and some of them could be insurable up to a certain threshold. So that one gives a bit more leverage to cover more risks, and it's for insurers that might want to really offer value to the insureds without kind of going into danger from a systemic point of view. So, and then you've got a couple in between. I think the reaction to these has been mixed so far. It's probably fair to say people are trying to get their heads around them. It's the first attempt really to create at a market level new cyber war clauses. So there'll be a lot of attention on this topic and debate around, do these ones do the job, or do they need further adjustment, or which of these versions is most suitable for the market, and so on. But it's pleasing at least to see that there's steps in the right direction. So that's the end of the slides, and yeah, over to the Q&A.
Cool, thank you, Rory. Our first question has come from, I think it's Laurie Leiden, and he asks, or she, how are insurers handling blurred lines and issues of attribution where you can't prove nation-state involvement? So attribution has always been a problem in the cyberspace. How does the insurance industry attribute?
Yes, so in the case of those LMA war exclusions, for example, they do rely on being able to attribute that. And I'm not a lawyer, but I can tell you that money was spent on using lawyers to firm up the attribution piece. So because it's a war exclusion, you can't get away from the need to attribute, but the legal people involved with that clause were confident that it gives you the ability to attribute with a high level of confidence, which more or less relies on things like reasonable inference. And if a country says it's been attacked by a nation state, then that's a good first step to being able to attribute. But the other approach would be to have exclusions which don't require attribution, but then we're not talking about a war exclusion anymore. We're talking about something like a systemic risk exclusion, which may be more fit for purpose in the cyber market, but it's not the direction that it's developed. I think just for historical reasons, it's been this infrastructure exclusion plus war rather than just pure systemic risk.
Okay, thank you. We don't appear to have any more questions, and if there are any questions, just type them into the question box and post them through. If we are sort of on time, but I will grab one more question. If there are any questions unanswered, we'll get Rory to provide answers and follow up. One of the previous questions was whether the recordings will be shared. They will. They'll be available on YouTube and the IRM website, and we'll share links subsequently. So there is one other question that we've got. In successful cyber attacks, the exploitation does not have to happen immediately. Exploitation could happen weeks, months, or years after the attack. Most organizations, countries have a short-term view of conflict and war. So how does the insurance industry deal with longer duration exploitation, and how are these risks factored in the pricing reviews and risk covers?
It's true that attacks can sort of lie dormant for a long time. So an attacker could establish a backdoor in a corporate network with a view to coming back later on, or sort of navigating through the network to the data that it wants to get its hands on, for example. So I think that sort of latency correlates to the higher severity losses, because that's a more sort of complex and sophisticated kind of attack. I don't think the market is, let's say, directly pricing that, but just in general, there's a recognition around factoring in severity of attacks. So it's priced in, but not sort of dealt with explicitly. And then in terms of the date at which the loss is reported, that would be the date of discovery, because another example is that a company might have a cyber attack but not learn about it until some months afterwards. So the date of discovery is usually the basis for when the claim is considered to be made.
Okay, that's great, thanks. So we're out of time, I think, but I'm just going to ask one more question, because I think it will be interesting to InfoSec and cyber professionals that are on the call. If organizations invest in something like 27001 certification, does this feature in the risk calculation by insurers? So all things being equal, with an organization without 27001, would they have a higher premium than one with? And indeed, if an organization cannot demonstrate basic cyber hygiene, will they even get insurance?
All things being equal, having a certification like that is better than not having it. And I know that certain underwriting firms explicitly build their underwriting framework to ISO 27001. So yes, it definitely helps, but I think there's not a sort of one-size-fits-all risk assessment approach. And I think now it's harder than ever before to get cyber insurance if you're not meeting the basic security. That's also true. Okay,
that's great. I think we'll call it there. I'd just like to say thank you, Rory, for making the time to present, and thank you for everyone who has attended. That's brilliant. Thank you.
Thank you very much.